Hey everyone, welcome back to Corporate Decoder, the place where we decode the most important financial documents to find the real story behind the numbers. Today we are going to look at SemiLEDs Corporation's latest 10K filing. And let me tell you, this is a story about a company fighting to stay afloat with some really interesting financial acrobatics. SemiLEDs Corporation is a company that makes light-emitting diodes, or LEDs. They design, manufacture, and sell these tiny lights, and also parts for them. Think about lights for general lighting, but also special ones for things like curing sticky stuff with UV light powering medical devices, some security applications, and even for growing plants with specific light. They have this special technology where they use copper alloy in their vertical LED chip design. They say this helps with making the light output better, and also removing heat more effectively. Copper is a great conductor of electricity and heat, which is pretty important when you are making these light chips. They are also developing really small footprint LEDs for things like mini LED applications and even sensors for smartphones and smart glasses, partnering up with some Japanese companies. But here is where things get a bit complex. The LED market is super competitive. They mention that the market is characterized by frequent intellectual property litigation. That means a lot of lawsuits about patents and trade secrets. They have a lot of patents, but also acknowledge that technological abilities of their personnel and ongoing product development efforts are more important than patents in the long run. Now, let us dive into the nitty-gritty, the numbers. This is where the story really picks up speed. They have been losing money. For the year ended the 31st of August 2025, they had a net loss of $1.1 million. And for 2024, it was $2.0 million. As of the 31st of August 2025, they had an accumulated deficit of $190 million. That is a lot of red ink, and their cash was only $2.6 million. This raises some serious questions about their ability to keep operating. Their auditors even put in a note saying there is substantial doubt about their ability to continue as a going concern. But here is a twist that saved the day financially in the latest year. While their core-led business is struggling, they entered into a bunch of buy, sell, purchase orders for equipment. Basically, they bought equipment and then sold it to a customer. This other revenue soared from $2.2 million in 2024 to over $41 million in 2025. This dramatically boosted their total revenue. Look at this table. Total revenues jumped from $5.2 million in 2024 to a massive $43 million in 2025. That is a nearly 730% increase. But the devil is in the details. Nearly all of that increase came from that other revenues category, the buy-sell equipment orders. Their actual LED component sales actually decreased from $2.7 million to $2.0 million. That means their core business is shrinking, while this new equipment reselling business is booming. And look at gross profit. It went up from $1.05 million to $2.4 million. That sounds good, right? But their gross margin as a percentage of revenue plummeted from 20% in 2024 to just 6% in 2025. Why? Because that equipment reselling business has much lower profit margins. So they are making more money overall, but on each dollar they make less profit. It is like selling a lot of candy bars, but making only a penny on each one. They are spending about the same on research and development, roughly $1.2 million. That is good, they are still trying to innovate. And their selling general and administrative expenses are almost flat at around $2.9 million. This shows they are trying to keep overhead low, but then we see a big jump in investment loss from unconsolidated entities. It went from practically nothing to almost $1 million loss for the year. This means some of their investments in other companies are not doing well. Other income also decreased significantly. It seems like they are not making as much from rental income or other sources as before. And even with that huge revenue jump from the equipment sales, the company still ended up with a loss before income taxes of $1.1 million. So that strategy of reselling equipment might be keeping them from going completely under. But it is not making them profitable yet. It's more like a band-aid than a cure. Let us look at the balance sheet. Accounts receivable jumped from about $400,000 to nearly $3.6 million. That is a huge increase and shows they are selling a lot more but are also waiting to receive more money from customers. Their allowance for doubtful accounts also increased slightly, which is expected when receivables grow. Inventories also grew from $3.6 million to $4.8 million. This suggests they are stocking up on more materials, probably to support that higher order volume, or maybe their core product sales are not as fast as they expected. And look at accounts payable. It exploded from just $100,000 to over $5 million. This means they owe a lot more money to their suppliers. This is a direct consequence of those buy-sell orders where they had to buy inventory. While it is good they are getting the supplies they need, it also means they have a lot of short-term obligations to manage. Their long-term debt has gone down, which is generally a good sign. They paid off some of it. However, their current portion of long-term debt also decreased. Stockholders' equity has improved slightly from $2.2 million to $2.8 million. This is primarily due to increases in additional paid-in capital, which likely comes from issuing more stock. The net loss attributable to SemiLEDs stockholders was $1.1 million in 2025 compared to $2.0 million in 2024. So the bleeding slowed down but is still happening. A net loss. Per S-Hair also improved from a negative 32 cents to a negative 15 cents. These numbers indicate that while the company is not yet profitable, it is moving in a less negative direction. The company is very clear about its need for more money. They say they need to improve liquidity access alternative funding sources and obtain additional equity capital or debt when necessary. They are planning to raise more cash through potential equity offerings and sales of assets. This means they might issue more stock diluting existing shareholders' value or sell off assets which could impact their operations. Interestingly, they have significant loans from their chairman and CEO Trung Doan and from Jung Simplot Company, which is their largest shareholder. In 2025, these loans were reduced to $800,000 from $2.4 million. They have also been repaying some of these loans by issuing shares of their own stock. This is a common strategy for companies in trouble, but it also leads to more dilution for shareholders. And one of the biggest risks they highlight is their listing on the Nasdaq Capital Market. They received a notice that they did not meet the minimum stockholders' equity requirement. They say they have corrected this by repaying loans with shares, but they warn that there is no assurance they will maintain compliance and their stock could be delisted from Nasdaq. If that happens, it will be much harder for investors to sell their shares and the stock price could really take a hit. Then there is the ownership structure. Their directors and executive officers together with their affiliates own almost 60% of the company's stock. This means a small group of people has a lot of control over the company's decisions. This can be good for stability, but also means it is hard for outside shareholders to influence anything or to get a new management team in if needed. Their main operating subsidiary is in Taiwan, and they mention restrictions on getting money from it. This is a common issue when dealing with international subsidiaries and can impact the parent company's financial flexibility. The auditors are very clear about the going concern issue. They say the company has recurring losses and an accumulated deficit raising substantial doubt about its ability to continue, while management has a plan involving cost reductions, more equity and growing that buy. Sell revenue, the auditors are not giving a guarantee that this plan will work. Let us look at how they recognize revenue. They say revenue is recognized when the products are delivered and ownership has transferred to the customer. They get purchase orders and recognize revenue usually at shipment. This is pretty standard. Inventories have grown to $4.8 million. This is a step up from $3.6 million. It suggests more production or slower sales of their core products despite the overall revenue increase from the equipment sales. So what is the story here? SemiLEDs is in a tough spot. Their core-led business is struggling and losing money. They are trying to innovate and develop new products, but competition and technological changes are fierce. The equipment reselling business has temporarily boosted their revenue and made their financial picture look better, but it is a lower margin business. Their ability to continue operating depends heavily on their liquidity plan, which includes raising more money. The fact that their loans are from their CEO and largest shareholder, and that they are repaying some of these with stock shows a company that is very reliant on its insiders. The Nasdaq listing risk is also a significant concern. Their financial performance shows they are still in survival mode. They turned a slight profit on paper due to that equipment business, but their core operations are still unprofitable, and their overall finances are precarious. The increasing inventories and accounts receivable alongside flat R&D spending, while revenue spikes from reselling equipment signal a company prioritizing short-term survival over long-term organic growth in its main business. Interestingly, their CEO Trung Doan and CFO Christopher Lee received relatively stable salaries and no bonuses. Mr. Doan's compensation has been flat at $243,000 for the last 3 years. Mr. Lee's compensation is also quite consistent. There have been some stock awards, but no option grants. This indicates a cost-conscious approach to executive compensation, but it does not mask the underlying financial struggles. All things considered, SemiLEDs is a company in transition facing significant headwinds. Their gamble on the equipment reselling business has provided a much-needed revenue boost and might be keeping them afloat. However, it comes at the cost of lower profit margins and increased short-term financial obligations. The company's core-led business needs a strong turnaround or a significant strategic shift to become consistently profitable. The reliance on insider loans and the potential Nasdaq delisting are major red flags for investors. For now, it appears they have no major new events to report after August 2025. So, what is my conclusion? SemiLEDs is a company fighting for survival. They have innovation in their DNA with their lead technology, but the market is brutal and their financial health is fragile. The equipment reselling strategy is a temporary fix, not a sustainable solution. Investors should be very cautious given the risks involved. Alright, that is our deep dive into SemiLEDs 10K filing. What do you think about their strategy and their chances of turning things around? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really helps us out, and subscribe for more decoded financial reports. And for more direct access and to chat about these filings, join our Discord community linked right in the description. Thanks for watching, and we will see you in the next deep dive.